Hey, um, let's kick off with Matt Stanley, Director of Star Fuels, sitting in Dubai. Matt, uh, we see oil markets open in Asia this morning falling after there was some optimism yesterday that we could get over that $70 mountain and hold, but that seemed to follow the same pattern as it has over the last number of weeks. This market just is much more comfortable, closer to 67, 66 than it is to above 70. What do you think is stopping the momentum holding above 70?
Morning, Sean. I'm on the lookout, by the way, for a pet jaguar. Someone's pet jaguar is roaming the streets around where I live. So if I have to duck off and hit someone with a stick, it's that.
So it's no longer a bull market; it's a pet jaguar market.
Exactly. We had animals last.
That's a Bitcoin version of a bull market. See, bulls. What's a bull? Jeez, yeah. That's something from the 1980s. You got to have a jaguar now.
Yeah, look, I mean, I think the argument is, can you form an argument to buy 70 oil? Where is the upside in buying $70 oil? I think that's the issue. And as we said a couple of weeks ago, if you're OPEC and you're flirting between $65 and $70 on Brent, you're happy. You know, that's mission accomplished. It's stayed in that range for about the last couple of months. You know, it's acceptable. It's clear that there is a ceiling. I would say probably 75 is the ceiling. I do think we will get back up to that 70, but it's very fragile. And news last night, this deal or no deal, as you said, about Iran, you know, the market dumped $3. As soon as that news came out, crude oil completely collapsed. And then it was, I'm not sure. I think I meant that. We're not sure. We might hear something today. So it goes to show you the fragility of the market. $70 is a little bit too rich for the market to absorb, but 65 to 70 is a great range if you're an OPEC producer.
Well, let's leapfrog over to Rome, so to speak, i.e. Dr. Sarah Vakshuri, founder and president, SVP Energy International, sitting in Washington, D.C., the Rome of the American empire, so to speak. But Dr. Sarah, you are a recognized and respected Iran watcher. Your thoughts on all things Iran-US rapprochement?
Well, good morning, and thank you for having me. It's been very interesting to follow everything, especially Iran's crude oil production and export since the Biden's election. If I want to give you a very quick overview of how Iran's export looks in May, we have seen a drop of export in compared to previous months, and the export dropped from about 800,000 barrels, 750, 800 in the previous month to about 560, lower than 600,000 barrels per day. But it does not mean that we do not expect that Iranian oil export to spike in the coming weeks, even by end of May, because what we see is that the government has changed the export grade of crude oil, which is again the formula or cocktail that they were exporting before the sanctions, which means that they are getting ready for sanctions removal at some point soon in the coming weeks, or perhaps starting from next month, because what they are offering in terms of types of crude oil, the types of export crude oil, is pretty much the pre-sanctions formula.
Dr. Sarah, do you think from the politics of all of this, does there need to be a deal before the election in Iran next month in order for there to be a deal at all? That once the election is over, it may be a lot more difficult. What are your thoughts on that?
We think that there is a consensus between different power centers in Iran that there should be some sort of agreement. So even if the agreement doesn't make it before the election, which it seems that with all the news coming out that there might be an agreement soon, but if there is no agreement by the election time, it does not mean that the deal is not close soon enough, because we think that as long as Biden administration is not pushing further pressures on Iran's missile program or support for certain proxy groups, then any power centers in Iran, right or left, or conservatives or moderators, do not have really significant issue with that deal.
Yeah, okay. We'll have to see where that goes. Ole Hansen, head of commodity strategy at Saxo Bank. Ole, the sort of news reporting on this morning is that once again, inflation concerns are what are dampening down the enthusiasm of the oil price. And your thoughts on that? It seems every week that no matter what the central bank, the Fed says, the concerns around inflation pop up again and dampen enthusiasm.
It does indeed, Sean, and it really is. We're still in this phase where we have to work out whether we are in a transitory phase in terms of inflation going higher. That's obviously what central banks would like us to believe. They may turn out to be correct, but we continue to see the inflation numbers move higher. It is to a certain extent obviously attracting investment demand into commodities as a whole because of the inflation busting credentials. But at the same time, crude oil has actually been one of the laggards over the past months or so. We've seen metal prices move higher now, also precious metals. We've seen agricultural commodities move higher. So I think that also to the returning to your first question that you've posed to Matt is the oil market. It took us 2 weeks to drop $10 back in March from 70 down to 60. Now it's taken us 2 months to climb back up to 70. It does indicate that we have a market which is concerned about the lack of synchronized growth in demand around the world. Yes, we are focusing one day on Europe, US, and spots in Asia, and then we're turning to the virus worries elsewhere. So, as long as we don't have the synchronized recovery in global demand, I believe as well that the 70 level is a bit of a ceiling, perhaps up to 73, the highs for a couple of previous occasions. But we need to see this global growth really start to kick off, because we also have to remember there are some very bullish forecasts for demand heading into the second half, and every day that goes by, that obviously that demand is being pushed into a shorter time span. So,
well, we're already trading August contracts, so I think it's we're essentially in the second half from a deliveries point of view. Yeah. Matt, we're still seeing this week. U.S. inventories report overnight from the API, at least the first of the week. We have the EIA today, but ultimately the inventory build was smaller than expected at 620,000 barrels. Your thoughts on the weekly dynamics of the inventory report? Ultimately, the trend line does seem to be consistently drawdown globally, but the U.S. does fluctuate up and down each week.
Yeah, absolutely. I think the data this week is a little skewed because of the Colonial Pipeline outage that they had. So there would be some, refinery runs would be down. It was only a temporary thing. Obviously, it did highlight the fragility of the infrastructure that the US have. I've traded that system before. It's not an easy thing to do. Each state has got their own spec. It's a very difficult, to meet the requirements. But in essence, yeah, look, product stock should be drawing down. It should be that time of year. I just want to go back to something that Ole just said. And from a personal point of view, I've always been skeptical regarding this second half demand making the resurgence. I was booked to go back to the UK in July. I won't mention which airline. And my flight was cancelled yesterday. Now, I find it incredible that an airline the size of the airline that I booked with is already pessimistic about travel that's supposed to happen in 2 months' time. That doesn't bode well for jet fuel making the demand, recovery it's supposed to. 5 million barrels of demand is still lacking, half of which is jet fuel. Now, if my flight in the middle of summer, when the kids break up from school, is being cancelled, I don't think that's a good sign.
I thought the current rule was, not to get too sidetracked, but nonetheless, that there's no flights between Dubai and the UK at the moment.
You can book them. They'll take your money.
Oh, I see. Okay.
Yeah, you can come in, but you can't go out. But obviously this Pete Schnaps, whatever his name is, Grant Shapps, he said that you can't, it's not advisable to travel anywhere at the moment. But I know we're digressing slightly.
They didn't put you on another flight. They just cancelled your flight.
They cancelled the flight, yeah. So there were 4 a day scheduled to go from DXB to London Heathrow, and obviously that's the destination number 1 from Dubai. India 30% of Dubai air traffic is sourced from India.
Right.
That's still shut. So I'm just looking at all of these, and what Ola was saying, that this can has been kicked, I would say, probably to Q4. None of it bodes well. And there is optimism and there is hope. And of course there is. I think the market is looking beyond EIA data, though. That's the kind of where I'm coming to. Yes, of course, for the prop traders, the intraday prop traders who are sitting there with stimulus money, selling Bitcoin at the moment. Bitcoin is quite incredible, actually. Just touch on that, even though I think it's it's not a commodity, it's not a currency, it's a speculative asset.
Well, it has been a reference for optimism and Jaguar, not bull market sentiment. But Dr. Sarah, can we just get a sense from you, sitting in the US and Washington, D.C. in particular, where most gas stations were shut during the cyber attack on the Colonial Pipeline? What's the latest there, and what do you think its impact will be going forward?
Well, I agree with Matt with regard to the instability and uncertainty over the global oil demand. But at least in the US, we see that the driving have been picked up, the flights on the domestic demand, people are traveling way more. And just having the cyber attack, even on that weekend, Sean, that there was not much gasoline available on the states affected by the pipeline. We saw many people still driving, not mention hoarding too. So what happened is that what we see on the gas stations is that the numbers of gas stations without gas have been reduced significantly. So we see that recovery coming up fast. Doesn't mean that now that we know that the whole world knows that Colonial Pipeline has paid a huge ransom, does not mean that this could not happen again. It increases the vulnerability of pipelines. At least so far, 83% of infrastructure in US are privately owned. And pipelines similar things happen, especially Colonial indicated that how much these states in US are dependent on this pipeline for their gasoline supply. But with regard to supply, well, obviously we see lower inventories of gasoline. This is right before the driving season in US beginning. And in terms of domestic demand in US, we see people are driving and things are getting way better because of the vaccinations. And
even with prices at what's called the 7-year highs, prices at the pump, very high ahead of a driving season. We got the Memorial Day weekend next week. Typically, prices at the pump this high would be discouraging for driving, but perhaps not this year.
Well, we see the prices reducing slightly, not to where they were before the cyber attack, but yes, there has been continuous. You could see still the traffics, even though that people knew that they might have stuck somewhere in the East Coast. There was like heavy traffic. The driving dropped a bit during the weekend and the last weekend, but yes, people are still driving, and I guess being frustrated being at home for a whole year, so they have resumed their travels both by air and on the road.
Ole, a few stories out of Europe overnight, which I think are worth touching on, perhaps not for their imminent impact on the markets, but nonetheless, the first was the IEA report. I mean, it's kind of unbelievable to see a report out of the IEA essentially saying, don't invest in gas or oil or coal, which is, I thought that was the whole, maybe they're saying we're closing the doors of the IEA in Paris, but nonetheless, your thoughts on that report, whatever its sort of fallout, where does it go from here, so to speak?
Well, I think it just basically highlights what an unachievable target it is to get to where we like to be in a couple of decades' time. If that's what it takes, basically having to shut down at a time where obviously the alternatives are not at a stage where it's strong enough to pick up the base load that's going to be needed from lack of oil, coal, and gas. So it's I think it's more just a stark reminder of the challenge that the world is facing over the coming years, and the need for inventions and to look beyond the current availability of alternative sources is really one that's going to be speeding up. And there's no easy fix. I know there's a lot of renewed focus on something like nuclear, but it's still a very, very small part of the global base load.
I mean, it could put an upward, in the midterm, an upward momentum on price if indeed IEA guidance is some kind of translates into strategy, which of course we're already seeing with the majors. But if this accelerates it even further, $100 oil 2023, 24 probably doesn't seem like a crazy bet.
There's a risk that that's the way we're heading, because one thing is whether we're going to see whether demand is going to return to where it came from in 2019. That's one thing, but obviously, if that's the way the oil majors start to behave accordingly, then yes, we do have an issue, and one that inadvertently will even throw more dollars after alternative sources, because obviously the price competitiveness becomes an easier one. So yes, there is a risk of higher prices, but let's just see whether they're actually going to respond to these suggestions.
And Ole, the other story out of Europe overnight, which you can see, I think, pretty much from your window of your bedroom, is the Nord Stream 2 pipeline. It would appear Biden has thrown in the towel on this project, and it's now pretty much going to be a done deal.
It looks that way, and even though we have the geopolitical aspect, U.S. versus Russia, there's also an aspect of staying friends with Europe, especially with Germany, and that seems to be the reason why this project has now been allowed to prevail.
Dr. Serra, your thoughts on that same project, and also what does it tell us about the Biden sort of doctrine, if you want, its energy doctrine? Obviously a central pillar of his domestic policy, as well as you might say international policy. So he'd love the IEA report, but he mustn't have loved having to sign off on the Nord Stream 2.
Well, going back to IEA report and Biden administration's policy, well, obviously as a vision, it's all perfect, but when it comes to implementation, what is very important to be reminded is that the affordability here is a key, because oil still is needed, maybe not as in terms of fuel. We're still using oil and petrochemical in different type of industries. Oil still has different types of use. And also for many different countries, emerging markets, developing economies, coal has an important role. So if we push all these visions and policies, if it turns into strategy and then action plans, it's going to have severe consequences on the affordability of energy and the prices for end users before the technologies are advanced enough to reduce the costs. And then this all could have consequences for increasing the energy poverty. So when we talk to companies, energy companies, despite the fact that they're all looking into investing more in renewable, but they're skeptical that all these goals might be met that fast because of the affordability issue. And as you said, at the center of Biden administration's energy policy is obviously the environmental issues, net zero. And if you look at the Nord Stream pipeline also somehow fits into that dynamics of natural gas being used. Europe and Germany need natural gas significantly. I'm just looking at purely into the lens of energy, because Ole already mentioned the political aspect, that it's important for US to obviously maintain its relation with its allies and Europe, because obviously it's important for Germany's energy security and energy strategy to have access to that Russian gas. Is there any other same equally low price just gas supply available that US could encourage Germany use instead of Russia? No. So Biden administration has not really any choice than accepting the fact that Germany needs that gas. There has been a historical relation between two countries, and that's a very important factor for Germany's energy strategy and policy. And also, at the end of the day, natural gas has an important role in Biden's policies when it comes to environmental issues and energy transition to a low carbon economy globally.
It was kind of a lost battle even when by the time Biden came into office, the Nord Stream 2 pipeline was pretty much nearly a done deal. He did have another big win, I would say, this week or today actually. The European Parliament is going to vote to freeze the investment treaty with China to consolidate a US-European posture against China, which I think is a whole nother bag of tricks there. But that's a big win for Biden because that has come into play since he came into office. But Matt, other thing dampening the sort of outlook for the oil price, as you said earlier, still confident it could go above 70, but ultimately is more the when rather than the if shale is going to come back. An interesting story on Energy Intelligence overnight. We have it in our digest as well, that the US majors more or less declaring that they're going to hold their fire until all of the OPEC barrels, the idle 8 million barrels, are back in the market.
Yeah, I think that's a sensible move. I mean, it's plateaued at 11 million barrels a day, US production. Shale is obviously a main contributor to that. I don't see the investment coming back in. Ole touched on that earlier. The IEA report yesterday, are the banks there willing to invest in new fossil fuel projects? I don't think so, especially after the hits they took last year when we traded down to -40. They're happy to consolidate around these levels at those kind of production levels that they've got as well. $65 a barrel we are on WTI. They're happy to probably hedge that all day long. I think they'll be looking at Iran, what happens there, as Dr. Sarah said, how much capacity is ready to come back and will it flood the market? I don't think it has a lot of say on crude oil. I think it has a lot more say on products. I think that the fuel oil market...
The Iranian deal?
Yes. Yeah, I don't think it will affect crude. Crude differentials may take a bit of a hit, but I think high sulfur fuel oil, Iran produce a lot of high sulfur fuel oil. They're now producing gasoline. They used to be imported as a gasoline.
I think where it presents a challenge on crude oil is perhaps competing with other members within OPEC Plus to make space for their return.
Well, arguably, allegedly, the places that were buying Iranian barrels, India and China, and I'd imagine that they will continue the current quotas that they're buying. It's to other areas. The South Koreans have not been buying it recently. Japan as well. So yeah, they may be scrapping there, but the Chinese, Rongsheng, which is one of the big refiners down in China, they bought 12 million barrels of crude oil yesterday. Demand is there. China is certainly there, and obviously we've got this new taxation issue in China that's had a big effect on products within China as well. This bitumen blend tax that came in, and light cycle oil is not being imported, so gas oil and distillates especially have gone nuts. But yeah, look, OPEC are certainly going to look at what US shale are going to do. That's always been a thorn in OPEC's side. And I think that is an investment play. Vitol have recently got into the shale patch. So I think
the majors have come around to not wanting to disrupt $65 oil as well. And clearly they're getting a big win out of that. Let's get the survey question today, which is sort of on this point related to the Iran deal. When do you expect the Iran deal to be completed? In the next month, i.e. before this presidential election in Iran, by the end of the year, or never? It's only three choices. There could be 33 perhaps, but nonetheless, we will just get a sense of the room on that. Ole, your thoughts, regardless of when it is, from the point of view of the Iran being rehabilitated, not only on the energy side, of course, one has to acknowledge right across the sort of global economy and the geopolitics and so forth. But in terms of its impact on the oil markets, has most of it already been baked in the cake because Iran has been exporting so significantly in recent months? You're on mute, Ole, sorry.
Sorry about that. Yeah, I think a lot of it has already been baked into the price, and I think we also have to probably acknowledge that if you look at some of the tanker tracking data that has been published in recent months, that Iran may even have been exporting more than what we see officially through the official lenses. So whether it's just a question of covert exports becoming more official, perhaps with an addition of some extra barrels, then I think on as a whole, it probably has. We probably have seen most of the impact already. But it raises as some of these barrels become more official and become more visible. It will obviously raise the question of where Iran stands with regards to the rest of the OPEC Plus group, because it will add some pressure on the rest of the group in terms of the future increases from here. So that one is going to be an interesting one to follow, because they are obviously far away from where they officially were before the sanctions were implemented. So it will take a while before they start to be they want to join any kind of deal.
Does it, Ole, do you think the fact that we've sort of come down to the 5-year average, which is the big target by OPEC Plus, that for Iran to return now is more easily accommodated than obviously previously?
Yes and no, but I would say it is, because it lowers the pressure on the rest of the group. But at the same time, we still have, as Matt also mentioned, millions of barrels of oil still not being asked for by global refineries, and we need to see that demand recover further in order really to make enough room for the increase in production that I'm sure they all desperately want to implement. And with that in mind, I think at the same time everyone is probably pretty okay with these levels around the $70 level. So stable prices in the foreseeable future, potentially with the short-term or the medium-term risk that we may see another disappointment, because demand is simply not accelerating as fast as the market has been, as we have been led to believe.
Well, Dr. Serra, on that point, while in Europe and in other parts of the world, the uncertainty of demand recovery is there, but it seems to be every week compensated by yet another great news out of the US. We now have about 1.8 million people getting on airplanes every day in the US, which is, if you like, the pre-COVID number was, I think, 2.6. So we're back to about 2/3 of that. Will U.S. continue, do you think, through this next season, summer season, to be the engine of oil demand?
Yes, of course. And as I mentioned, U.S. domestic demand, especially on the traveling side, has been picked up significantly. And unless we don't have any unsurprising news that people vaccinated could not or should not travel freely, people in US are pretty feeling comfortable with traveling, and they haven't been traveling for a long time. And even before COVID, US driving season would always drive up the global demand for gasoline and oil during this time. So yes, we think that US now for the coming quarter and the driving season in the summer is going to push the demand up for the fuel, for driving fuel, especially in transportation industry. And just adding one small point on Iran is just to agree with everybody that the country's export have been increased, and as you said, the Iran's returning to the market has partially baked into the prices, because they have been exporting between 800 to 1 million barrels per day in the previous months. So what is going to come back from Iran to the market gradually by the end of the year, if you add 1 million barrels per day to 1.2 million barrels per day of additional Iranian oil coming back to the market, if we have the demand also gradually increase to the similar levels or higher, then the market should not have a significant problem to absorb additional Iranian oil back to the market. Also, we have the OPEC that they might agree to open room for Iranian oil coming back to the market.
Well, it's certainly in everybody's interest to ensure doing nothing that jeopardizes the price. Even Iran would agree to that. But Dr. Sarah, just very quickly, final question. What about the return to office? Clearly 1.8 million people are more than happy to get onto cramped airplanes. Are they willing to get back into the office? And will that happen also in the coming months? That sort of urban commute, you know, that's a lot of oil demand as well.
Well, I just want to give you an example on myself. The whole year of COVID, we were working from home. My commute to seeing people actually in person is just still very limited to once or twice a month. Universities, still I'm going to teach virtually for the summer semester. So that in terms of commuting back to work, this is a behavior that still is very uncertain. There's so many workplaces that they have benefited from this, just having their workforce working from home. So this is something that is still not clear how fast is going to recover. Still people are enjoying working from home, and also on the other side from the benefits, cost benefits for the employers. But obviously what I could imagine is that from at least in terms of universities and schools being more in person from the fall, just when we finishing end of summer and entering a new semesters, we're going to have more students going back to universities and to schools in person, which means more professors, teachers going back to, and then we might have seen that actually more in-person people working actually going back to the offices, when we approach end of summer.
And more CEOs issuing memos saying, get back in the office by Monday. Yes. That's probably where the big stick comes out. Let's get the survey question, give Matt the last word today. In the next month, 41%, by the end of the year, 50%. Never essentially is a very small minority. Matt, your thoughts on that and what you might be watching for guidance for the market the rest of the week?
I thought I was pessimistic. Whoever voted never, God, they need some Weetabix, I think, or something.
Well, if they miss this window of the next few weeks, I would be in the never box. But I think this window of the next few weeks is critical, and I think they'll do it.
I think Russ Edwards put it, one more selection by the end of the month. I agree with that. I think that, Dr. Sarah said that 1 million to 1.2 million barrels of Iranian production could come back. We've got 2 million barrels of OPEC production to come back by the end of July. I don't see demand keeping up with that in any way, shape or form. The sad thing is that whether it's sad, I don't really know what the adjective would be, but COVID is no longer news. Latin America, India, Thailand, Vietnam, they're all going through these devastating second, third waves, whatever you want to call it. And it's no longer really being discussed. The pandemic is far from over. It's still going to have a massive bearing on sentiment, stimulus. One of the quotes of the year so far was Mark Oswald you had on Monday when he said, once the economy starts to recover, we will see unemployment surge, because there will be no more free money. And, how are people going to afford to buy Popeye's chicken sandwiches during the day in the bottom of their mum's basement? It's this new realm of understanding that we're all in. But I think that crude will stay in a $65 to $70 range until we really see some tangible data that demand is returning as quick as supply is.
Well, we saw also on that point, we had Narendra Tanea on yesterday, one of the leading energy voices in India, and he said the spread of the COVID into rural India now is very alarming, and without any real data point to sort of measure it, but only that it is significant. Listen, we'll have to wrap it up there. Clearly, prices opening in Asia this morning downward, with the glass half empty sentiment winning at the moment. It seemed yesterday was the glass half full, but now that there's a Jaguar out in the loose, wandering around the streets of Dubai, perhaps that may have its own impact. Matt, thank you so much as always. Ole from Denmark and Dr. Sarah from Washington, D.C. Really appreciate your time this morning, or in D.C. I don't know what it is, probably late in the evening or early in your very early morning or something like that. Listen, all the best, and we'll catch up with you in the coming days. Thank you very much.
Cheers.